Hello, this is Josh Belk with Belk on Business Podcast. It's been a while since we recorded one of these, but going to try to get back on the horse on the recording. Brought back in the gentleman who started this off recording with us to kind of help us with this next number of podcasts, and hopefully it's a long-term relationship again. And today we're going to talk, actually start talking, and over probably the next 4 to 6 weeks, we'll be talking about this big, beautiful bill that was passed earlier this month. And today we're going to strictly focus on 3 of the campaign promises, not all of them, but 3 of the campaign promises that ended up getting included in the bill. The one we're not going to talk about is overtime. We'll talk about that one in a later podcast. But today we're going to talk a little bit about kind of the 3 of the other ones as it relates to no tax on tips, no tax on or deductibility of car loan interest, as well as the no tax on Social Security. And of course, for someone like myself who's an accountant, when we kind of heard these campaign promises, the first thing that came to mind is, what is this going to look like? It's going to be very difficult. And so it's not categorically true that you're going to be able to, not pay tax on all of certain things, such as Social Security, whatnot. There are some caveats to it, and they're going to handle this primarily through deductions. So I'm going to kind of talk through 3 of these today, and then we'll pick up at a later date in regards to some of the other campaign promises and what this looks like inside of the bill. So first of all, no tax on tips. So for 25 through 28, now some of the components of the bill made the old Tax Cut and Jobs Act, certain elements of it permanent. Okay, there are other portions of it that are only over the next few years. So in the case here with no tax on tips, it's going to begin for 2025. It's actually going to go back to the beginning of the year through 2028. Employees and self-employed individuals may deduct qualified tips received in occupations that are listed by the IRS. And so what we're going to see a little bit later on this year, they have not issued the list yet, but a little bit later on this year, they're going to issue a list of occupations that they state that you can exclude the tips from income, or at least take this deduction. So, and there's a lot out there. I'm not on social media, but I've heard a lot about, on social media, people saying, well, I'm going to go through and, I designed something and I'm just going to, anytime I get a tip or anytime I sell something, I'm just not going to report it. That's not the way this is going to work. Okay, so it must be an occupation that the IRS says these are qualified to receive tips and qualifies you for the deduction. So you think of the normal things you'll see on there, such as waitresses and things, the wait staff, things of that nature that are kind of customary that will be on that list. And so for our clients, and we do have a number of them that own restaurants or similar types of organizations, these are big questions. So what we're going to see a little bit later on this year, we don't know exactly what this is going to look like, but there's going to be the W-2, the 1099, et cetera, are going to have sections on there that are going to reflect the tips that were earned. So qualified tips are voluntary cash or charge tips received from customers or through sharing if they do pooling. So it is something that's given voluntarily by the customer. I think we understand that. So how they're going to handle this is they're going to, the IRS is going to have up to a $25,000 deduction for tips. So if you earn over $25,000 in tips, and I don't know if a lot of people do, but if you earn over $25,000 in tips, obviously you'll pay tax on it. But anything below the $25,000, you'll get that deduction for whatever that tip amount is. And so the deduction cannot exceed your net income. So it'll bring it down to 0. You cannot take that deduction to create any sort of a net operating loss or anything of that effect on a tax return. Same thing, think of itemized deduction, standard deduction, for example. Those cannot create an NOL. So you can take the $25,000 deduction, provided your income is below $150,000 if you're single, $300,000 for joint filers. Self-employed individuals under Section 199A that have a specified trade or business are not eligible. Now, I'm not going to go into depth a whole lot now in regards to your specified trade or business. I'll just give you an example. So most of those businesses are kind of health-related, doctors, lawyers, things of those types of things, where the skill relies on the owner or one of its employees. Now, for example, I own an accounting firm, and it rarely happens anymore. Maybe once or twice a year, I'll have a customer that may pay over the invoice amount since everything's electronic. But back in the day when it was just me and I did a lot of individual tax returns and whatnot, I would have clients that would tip me. So they would, they'd give me cash, maybe beyond it, or write the check for more than I earned. Now, in the case here, since this is a specialized type of a business, the essentially the business requires a skill of myself and others in the firm who are licensed. If my employees would receive a tip or if we would receive a tip, we would have to be reported and would not qualify for the $25,000 deduction. So we're going to see this list a little bit later on this year in October the occupations that will qualify. So if it's something you think you may qualify, you may want to take a look at that list. And then obviously, if you're an employer, you'll want to do this to help your employees out. And so there will be some sort of a process also given a little bit later on this year as far as the reporting, what that's going to look like. And then there is both with this and then also on one of the later ones we'll talk about, there is what the IRS is calling transition relief, which means that there's going to be some flexibility. Your employer is going to have to go back and try to determine how much in tips were received so far this year, kind of do all that work. So there will be some transition relief. I don't know exactly what that's going to look like. But it's not kind of one of these things where it's going to be a hard, fast type of an issue. There's going to be some wiggle room if there are some mistakes. Secondly, the deduction for car loan interest. Okay, so this was something else that President Trump, when he was campaigning, talked quite a bit about, and deducting car interest. And this really was kind of one of these things to try to help to have more vehicles that are manufactured here in the United States instead of going overseas. Now, I happen to drive a car, and the gentleman, Josh, who's recording, we both drive foreign vehicles, okay? And so we don't drive domestic vehicles, so if we were going by it, I think we drive Mercedes, Josh, I think. They have a Mercedes, I have a BMW. That means we're going to have a fight out back after this thing is over with. We're not supposed to get along. He drives a Mercedes, I drive a BMW, and so those vehicles generally not manufactured here. Those are vehicles from overseas. Sweden, and where's yours come from? Like Iraq or something? Germany? Okay. All right, I'm messing with you. So, so those vehicles from overseas, they will not qualify. You cannot qualify for the deduction. And so if you're buying a vehicle that is manufactured here in the States, you can get the deduction. So, so if you do purchase a vehicle, 25 through 28. So once again, it's for these years. It is a domestic vehicle. Now, online, there is a bin, kind of a bin locator, a bin tracker that you could use. You can go there, you can click on it and enter in the bin, and it will tell you whether or not the vehicle is manufactured in the U.S. So it'll be a helpful tool for you if you do purchase a vehicle this year, if you want to know if it was domestically manufactured, and then for the deduction. When you go buy the vehicle, then you're probably a good question to ask. So it must be a new vehicle, so not a new vehicle to you, a new vehicle overall, okay? And it cannot be a commercial vehicle. So it has to be bought in your name, it has to be a personal use vehicle and any personal vehicle. So the vehicle must weigh less than 14,000 pounds. It has to be a car, minivan, van, SUV, truck, or motorcycle, okay? So if it's over the 14,000 pounds or it's a commercial use vehicle, it will not qualify for the deduction. And you will be able to take the deduction, the $10,000 deduction, regardless if you itemize or not. So a lot of these types of things in the past have been an itemized deduction. In this case here, it's going to be a deduction beyond beyond your standard deduction or your itemized deduction. So there will be a reporting requirement that's going to go out a little later on this year for the lenders to issue. You think if you have a mortgage, they send you every year a 1098 that shows you the amount of the mortgage interest paid, etc. I would assume we're going to see something similar as it relates to the car interest. A statement going out showing how much interest was paid during the year. And once again, in this, there is some transition relief. And then lastly, we're going to talk about the no tax on Social Security. So for 25 through 28, so this one does not extend past this either, this time frame. Individuals who are over 65, meaning they turn 65 before the end of the year, and they can take a deduction up to $6,000. Okay, so it's kind of one of these situations that it's not going to be all of your Social Security. Now you have to realize that only 50% or up to 85% of your Social Security can end up being taxable depending on your income level. Give you an example. So currently, if you're over 65, you file as an individual, and you make under $25,000 in other income, you won't pay any tax on your Social Security. Once you're over that, you'll start to pay 50%. Once you're over about 32,000, I'm sorry, married is 32,000, there's no tax. And then once you're over that, then it'll be either about 50%. If you earn even more money, it could be up to 85% of your Social Security ends up being taxable. So if you're making over 25,000, if you're single, 32,000, if you're married and other income, you could or will end up with some tax exposure if you make over $6,000 from Social Security. Also, one note on this, there are still 9 states currently that do still assess state Social Security tax on Social Security income. So you'll want it. So if you do live in a state where normally you file and because they do tax Social Security, and you're thinking, well, now there's no tax on Social Security, you'll still need to file. So once again, kind of these 3 areas we talked about: the no tax on tips, car loan interest deduction, and then also the no tax on the Social Security. The rules aren't horribly complex. Still kind of working through some of these things, but I encourage you, if you do receive tip income, if you're looking at buying a vehicle, or if you're over 65 and you're in Social Security, these rules are going to impact you. Once again, this is Josh Belk with Belk on Business Podcast. Have a wonderful day.